Okay, so good morning. Welcome everybody, and thank you for coming here today with us for this conference on finance governance after the crisis, challenges for the EU, Latin America, and the world. My name is Dimitris Katsikas. I'm an assistant professor at the National and Competition University of Athens and director of the Research Center on Economic Policy, Governance and Development. Our research center is organizing this conference as part of the Jean Monnet Network. Is this okay? Jean Monnet Network, Crisis, Equity and Democracy for Europe and Latin America. In a few minutes, Professor Andrea Hoffman from the Pontifical Catholic University of Rio de Janeiro, who is the coordinator of the network, will say a few things about it. Our topic today is the evolution and governance of the international financial system with an emphasis on the EU and Latin America. The financial system, as you know, is of paramount importance in modern economies, modern day capitalism. It generates the funds for growth and development. It's at the heart of the payment system across the world. But at the same time, in recent decades, it has been a source of instability in the current crisis, which have resulted in huge losses for taxpayers worldwide. Typically, after every crisis, we have a reform effort, an effort to re-regulate the financial system with the hope to avert a future crisis. But as we all know from recent experience, this has met with limited success in many times. Particularly after the global financial crisis, it was a huge, unprecedented in the post-war period effort to re-regulate the system. And we all thought, and it is true to a certain extent, that the system is much more resilient now following these reforms. But of course, unfortunately, the recent developments, the recent financial turmoil with the collapse of several regional banks in the United States and the continued pressure on others, and of course, the troubles of Credit Suisse in Switzerland, and Credit Suisse, I remind you, is a globally systemic financial institution, reminds us that the effort remains incomplete. Therefore, unfortunately, because I would rather not have this financial turmoil anew, our conference is very topical. And it's a very interesting point in time to discuss these issues. I'm very happy because we have a great group of scholars and academics and policymakers today with us, very distinguished, very experienced, and will share their wisdom on these issues with you. And I'm looking forward to a very interesting discussion. I don't want to delay anymore the proceedings. I would just like to ask Professor Hoffman come up and say a couple of things about our network. Thank you.
Thank you, Dimitris. Thank you. Good morning. Welcome, everybody. I also would like to thank you, Dimitris, for organizing this program and for your presence here. As he said, we are part of the Jean Monnet Network, Crisis, Equity, Democracy for Europe and Latin America. This network was created in 2015, and Bettina Guilherme is here. She was one of the regional idealizers of this network. She'll be able to greet you as well soon. She'll be in the table, chairing the next table. And this network of scholars from different universities and think tanks all over Latin America and Europe. We have most of our partners are represented here. Jose Bricen from UNAM in Mexico, Andrea Biancoli from eBay in Spain, Federico from the EIE in Rome, Stefan Schulmeister from Austria. Of course, you are here. And if I'm missing someone, we have over the conference coming online as well. Christian Gimmers from IRELAC in Brussels, and also Stephanie Griffith-Jones, who will also be only online, and others. So we are a network then of scholars who have been discussing these issues, crisis, equity, and democracy for Europe and Latin America since those times. And you are here in Greece. You also went through a lot of these problems in terms of economic crisis and political crisis. And in Latin America, we had even recently, for those who know, in Brazil, a very difficult government, a far-right government for the first time in history. And we see that in other countries as well. So the type of challenges changed over those years since 2015. But unfortunately, what we saw is that not necessarily got better in terms of the relationship between those crises. And we now have also being the center of those discussions, the climate change. We don't address that here as much in this conference, but in other conferences from the network. So the invitation here is for you to connect those crises. That's what we try to do in the network. We have a very interdisciplinary group of scholars from economists, sociologists, political scientists, and we try to connect all those systemic crises, being climate change as well, but financial, economic crisis and political, and especially look at those relations then, to what extent stability and more equity and more also accountability in those systems of governance are important. And of course, being funded by the European Commission and the Erasmus Plus, we have a focus on the regional level as well. To what extent in Europe, the EU, of course, is an organization much longer and with much more also mandates. In Latin America, we have several regional organizations. It's both pulverized, but we have also studied the role that those organizations can play between the local level and governmental level and the federal level as well. Now, local meaning really local governor level and the UN system and other multilateral initiatives. So I won't talk too much more. I just want to welcome you as well for today and tomorrow, and I hope we have very productive discussions. Thank you.
Thank you, Adria. Just a small note, Vasilis Nikitas, who was to represent the European Commission, because just as Andrea just said, this is an EU-funded program. Unfortunately, he called us yesterday, and there's a kind of family emergency, he couldn't make it. So we move right on to our keynote speech by Mr. Zavvos, Chairman of the Board of Directors of the Hellenic Development Bank.
Thank you. Thank you, Chairman.
So, we are very lucky to have today with us Mr. George Zavvos, who has had a long and distinguished career in public service, particularly in relation to issues of banking and finance. Mr. Zavvos is currently the Chairman of the Board of Directors of the Hellenic Development Bank. Before that, he was the Deputy Minister of Finance in charge of banking, securities, and private insurance sectors. Being in charge of the reforms in these areas, he launched and implemented the Hercules Asset Protection Scheme, a systemic solution for the reduction of non-performing loans, which was a huge problem in Greece. He will talk about these issues in a minute. He also introduced reforms on corporate governance capital markets. George Zavvos served at the European institutions for over 30 years. More specifically, in the 1980s, he worked at the European Commission's DG for Financial Institutions and Company Law, where he was in charge, actually, of drafting and negotiating the all-important second banking directive. Between 1990 and 1994, he was elected member of European Parliament. Between 1994 and 1997, he was appointed as the first European Commission ambassador and head of delegation to the Slovak Republic. Between 2002 and 2017, Mr. Zavvos was a legal advisor at the Legal Service of the European Commission involved in banking and capital markets regulation and reform, and he has pled in the EU Court of Justice over 100 cases. And between 2018 and 2019, Mr. Zavvos was senior advisor on economy and finance in the Center for European Policy Studies, the well-known to everybody CEPS in Brussels. Mr. Zavvos was also professor at the Solvay Business School, the Free University of Brussels, the visiting professor at Queen Mary University of London. He holds a Bachelor of Law from the National Kapodistrian University of Athens and a postgraduate degree of EU Law from the College of Europe in Bruges. He has written and lectured extensively on EU banking and financial services law matters, and his doctor honoris causa at the University of Economics in Bratislava, and has been awarded the Double Cross of the Slovak Republic. We're very happy to have you with us today, Mr. Zavvos, and we look forward to hearing from you.
Thank you very much, Professor Katsikas, and thank you very much all the organizers and you especially for inviting me to talk about some of the most topical issues I think that financial system faces currently. And also to mention that it's been 30 years since the establishment of we celebrate these days, of the European single market, the so-called Delors at that time initiative, whose cornerstone is the European banking market. Also, there are 25 years since the time that ECB, the European Central Bank, was established. Let me say that seeing the participants, I think you have a very inspiring and multidisciplinary audience, and will give me the possibility also to address in a more discussing way, you know, some of the issues that, as you mentioned, I have been working with throughout my my professional career. It is also, I think, a good somehow coincidence that you organized this conference around this time, since it is 15 years ago that Greece found itself in the midst of one of the most, I would say, terrible twin crises that has shaken the country and has shaken the Eurozone, a twin fiscal and banking crisis. Nonetheless, during the last 4 years, Greece has managed, against, I would say, all adversities, all crises, to reverse the course, especially of its banking system and of its economy. And as you follow, I suppose most of you now, there is an extremely well-performing situation. It gives me also the possibility, I would say, today's discussion to talk about some of the crucial issues of European governance that you'll be discussing in European institutions, in governments, in universities, and that will need, I think, some more thoughts, some more contributions, and even some more political actions. I'll focus my presentation in 4 main issues, which somehow are related, you know, to my career's journey. The first is the European banking market, which is marked by the single license. When back in the 80s, end of the 80s and 90s, I was assigned with the drafting of this very important legal instrument that aspired and to the great extent has achieved, you know, the opening of the European banking market. What we call today the European passport is the thing that the Brits, unfortunately, following Brexit, do not have anymore, and they know what is the cost. The second issue that I will be discussing with you, there was the European financial crisis, focus also around 2 issues. One is the initiatives that European Commission and other institutions has adopted, and more importantly for me, how we managed through the Hercules securitization scheme, which I'll explain to you what it is. Can I get probably to...
Can we put the presentation back?
Okay, so here I am. And here is the first issue then, which, as I said, is the first issue I will be discussing in the banking market of 1992. The second issue will be the euro area crisis. The third issue will be the recent banking crisis, mostly stemming from US. And the fourth is going to be the role of developing banks. Have I done something wrong here? Yeah. And the fourth issue is going to be the role of development banks, like the bank I'm chairing the last 10 months, which is the Hellenic Development Bank. I have put this here, this citation coming from an EU governor of the Irish Central Bank, indicating the importance of what we call banking union, that a banking union needs to be based on a single market. I don't think that works, this thing. Okay. Is it okay here? Okay, great. So what one has to bear in mind is that the European Banking Union is one of the most important milestones of the European Union, but this milestone is based on the 1992 Second Banking Directive, whose main instrument is, as I said before, the single European passport. What does it mean? It means a bank established in Athens can open branches throughout the European Union without being required a new license or other, I would say, conditions for conducting its business. It's a kind of idea that you opened and you have a European market as if it had been a national market. However, this market that started with the best omens has come across the so-called the great financial crisis of 2007, 2009 that has tested its very foundations. And why? Because during that crisis, the Eurozone and the European Union was hit by a banking crisis, as you know, with some important signs of immense outflow of deposits, massive exodus of investors, especially in countries like Spain and Greece. What are the scars that this period has left upon the European Union? First of all, it has exacerbated the fragmentation of what we are calling a European Banking Union. It has shaken the roots of stability, financial stability. Why? Because at that time, national authorities tried immediately, as a reaction to the crisis, to ring fence, to keep banks within their limits. And therefore, you can imagine international banks crossing the borders. They were kind of split between home and host state authorities. This crisis has also reinforced the so-called doom loop, which is the relation, the interdependence between national banks and the sovereign. But also, as a response to this crisis, the European Union has taken some very important initiatives to reinforce its architecture of financial governance. One is the establishment of a single supervisory system, which is within the ECB, which has been, I think, a great success. And the second one is the establishment of the Single Resolution Board, which is an agency, also established in Brussels. I had the chance also during that period, I served the legal service of the European Commission, to be amongst the, I would say, the lawyers that had to draft matters pertaining to the establishment of the SSM. And also, as some of you discussed this morning, the SRB, the SRM regulation and the SRB agency. If one would ask me today to make an observation about the status of the European Banking Union, I would say that unfortunately, 17 years after the eruption of the financial crisis, this market still remains fragmented. It's important for the cost of finance, for its citizens, for the banks that cannot fully deploy their means throughout the European Union, for the cost of financing. And this despite the fact that the heads of state of the European Union within the European countries have already taken important decisions back in June 2012 to establish these institutions. I would say the ESM, the SRM, SRB, and especially the deposit guarantee system. Another issue on which is European Union is lagging behind, especially with comparison to the US, is the not yet fully developed, not so liquid capital markets union. Let me now come to the second part relating to what we did here in Greece during the crisis, when Greece was hit, I would say, point one, mentioned before, with the huge fiscal crisis, that was the problem was main fiscal crisis, failing the public finance, and then a banking crisis. You have to bear in mind that Greece during this crisis has seen the contraction of its GDP going up to 26%. That's something never seen during a peaceful time in any country around the world. At that time, around 2016, the NPLs, the non-performing loans, what we said, red, bad loans, around the Eurozone amounted to 1 trillion euros. Greek NPLs were only 107 billion. You can imagine what it means. An atomic bomb at the basement of the Eurozone. Coming to the office on the 7th of July of 2019, my office as deputy minister responsible for the financial system, meaning responsible for addressing the issues of NPLs, the situation was the following. The Greek banks' NPLs amounted to a dizzying number of 76 billion, which is close to 45% of the entire portfolio of banking loans. This number had gone 8 times up since the 2008, up to March 2019. So what we had to do when you come to the government and the prime minister tells you, you have to do something to address one of the most important issues facing currently the country. I would say, I think to a lot of academics, highly knowledgeable, several times I remember of Kenneth Galbraith saying that specialization is a scientific convenience, but it's not a political virtue. And in order to be able to combine both, you need really to be able to master the details, but also to master the political realities. Therefore, I had within a very short time to design, negotiate, legislate, and implement the so-called Hercules Asset Securitization Scheme, which is a program, I show you also some of the slides later on, is a state guaranteed securitization program assigned to remove the NPLs from the banks. It was a market-based mechanism. Therefore, with Hercules, we're trying to raise money from the capital markets, not from the state budget. And that's a very important point. And therefore, to be able, within a very short period, to function efficiently. I'm putting here 3 great challenges. First of all, Hercules took political determination. The Prime Minister has said that cleaning the NPLs from the Greek banks was one of the 3 fundamental conditions for the country to make not only the step, but the leap of the decade. Second, as you can understand, the magnitude of problem forces us to move in high speed. Speed was of essence because of the financial stability concerns, because of the sustainability concerns regarding public debt, and also the need to encourage recovery and growth. What we did at that time, we had to see that, discuss various options, but it was the closest one we could follow. It was the so-called Italian model. Here is I'll explain you later. Here is how Hercules has functioned. The Italian model is the tax scheme, but implementing that, adopting that for Greece had a huge difference. That Greece was a non-investment grade country, whereby Italy was. And the European framework giving solutions was designed and to address issues regarding the investment grade countries. The securitization system I'm talking about works as follows. Let me explain here. The banks are here having the NPLs loans. We have to find a way to move, sell the NPLs and put them in an SPV, single purpose. Yeah. We have to move the NPLs from the bank's balance sheet and move that within an SPV, which is a legal fiction. This has to be done in a proper way, and this being sold, and you cut any link with the bank. When the NPLs are here, they are managed by what we call a servicer, specialized, very important international firms with capital. We have come to do this job. But the important issue is the structure of the securitization. You put here various types of loans, but you have to classify them in three basic categories. The one category is the so-called senior notes. In other terms, is the best part of the NPLs portfolio that has been rated by the international credit rating agencies, the most secure, the most transparent. Here is the mezzanine, and here is the junior. Regarding this senior part, the state provides a guarantee. I signed twice, 12 and 12 billion euros, of guarantees. But the guarantee, as you know, is not a money given. The guarantee, first of all, is paid for being provided by a fee that the banks pay, and also is a means of credit enhancement to help the investors to come and buy these bonds. As you can imagine, here being the most conservative part, the most I would say transparent, you have more conservative investors coming and buying. Here you've got the ones who have more risk appetite, and here also the ones who have much more risk appetite, but is a part also retained by the banks. Needless to say that here as I say, the investors buy notes issued based on the collateral of these bonds. State provide the guarantee only for this part, and receiving back the guarantee fee. With this structure, we have managed to clean, as I said, within record times, the NPLs, remove them from banks' balance sheet. Let me tell you very quickly what were the three main challenges that we had to face during the negotiations. The first one is that the guarantee provided by the state, it has to be state aid free. In other terms, is a guarantee that is given on market terms that could have given by any other private market participant, like another bank or another or another financial company, and it's paid, and it is a fee that banks pay for this guarantee. The second issue is that this whole guarantee should not be reflected in the state debt. And that was an extremely important point, because there were other solutions requiring to put state's money, taxpayers' money, and you can discuss that even later on in that. But when you provide a state guarantee, that is a contingent liability. In other terms, it is reflected in the state debt nomenclature only when it's coming in, when it's called in. And the third issue, and probably the most important of all negotiations, was to be able to qualify under the prudential treatment of the SSM, the senior tranche, I'll say the most transparent, as zero risk. That was extremely important for the whole operation. In other terms, that was carrying less capital charges for banks. And that's the moment we achieved that, and I can tell you it was not the easiest thing in the world, and I can discuss later on. I see here some of the Bank of Greece who understands, he knows this issue at that time, the difficulties we faced. Then we had, I think, could advance very well with our operation. Moving on. Let's move on. I don't know here. Okay. Here are the three tests I talked to you about. Here is now the achievement, the results, the measurement of this whole operation. This is the European Commission, if you want slides, that comes back a year ago. The Greek's NPLs banks were, as I said before, in 2017 here. By the end of December 2021 had come down here, and now they're around 6%, or eventually less than 6%. This has happened nowhere in the world before. And mentioning that, I could say two things. Point one, that if I try to say in a nutshell the contribution of Hercules, is that this scheme has contributed to financial stability, has allowed banks to provide increased lending to the real economy because banks start giving loans again. And very importantly, to act as a transmission for the very important funds, around 30 billion funds that Greece is receiving, therefore acting as transmission mechanisms for these funds to the real economy. Also, Hercules has been the key rating factor in 13 successive upgradings of the Greek banks and the Greek economy throughout the last few years, leading Greece these days, and I hope the next few weeks, to the investment grade, a very important milestone, a very important event. Let me show you this that was written 2 months back by the Bloomberg. And note this, non-performing loan ratio that was reduced, as it shows in 2017, from 47% down to 6.8, was reduced by at least, Bloomberg says, 32 percentage points, a magnitude of improvement unsurpassed by the banking industry anywhere. So I think it's useful, this part of comparison. Saying, therefore, that the Hercules has helped financial stability, you can only imagine what could have happened if Hercules was not there and Greece, as any other country, had to face the pandemic crisis, the Ukrainian war, and the more recent crisis in the US. The second issue is that Hercules also, as I said, has given the possibility for banks to extend credit again to the real economy. A third issue is that banks that seen their profitability raised came back after a long year to the international capital markets. They became investable, and therefore they had the possibility of being able to raise capital to finance their operations through share capital increases. And as I said before, channeling around 30 billion RRF funds currently to the Greek economy is a major achievement. Also, the rating factor and Greece heading towards the investment grade is also very important for the operation of Hercules, which has removed the NPLs from banks' balance sheets, but needs also now these NPLs to be removed entirely outside the Greek economy. And here, Hercules has helped to enhance, to promote a secondary NPLs market that is a very crucial mechanism to clean entirely the NPLs from the economy. Let me say now that Hercules has some very important, I think, messages, lessons for the European Union, and I would dare to say that a lot of people, member states, that they are not EU member states, which I hope not, but if they ever face a mounting raise of NPLs, could use this instrument for which we have a kind of technology, to address similar crises. Hercules demonstrated for the European Union how a national reform managed to solve a problem that, if it was left unaddressed, might have effects through spillover effects and contagion the entire Eurozone. Hercules also, it was an important precondition for the European Union moving in a front-loaded implementation of the ESM treaty. It also sends the message and the lesson of how, through risk sharing between banks and private sector, you can solve these very important issues of NPLs. How, through securitization, that is an important instrument of capital markets, you can solve a very important problem of the banking market. And there are still, I think, the important message that EU needs to advance not only through national means we used here, but also using much more reinforced framework, guarantees, and other mechanisms to be able to solve, if ever is again, a problem of NPLs. I'm passing now to the fourth issue, and I don't know, Professor, how much we still have? Okay, great, and then we can discuss. Yeah. Now I'm touching upon the third issue, which is the new banking. Here are where I would say the various lessons and achievements we have. Now, going to the new US banking crisis with Credit Suisse. That, as I said before, force us to reflect about the very basics of regulation and supervision. As we know, I'm not getting into details because I suppose all of you have followed, the recent events in the US, but we will make some observations. We've seen that Europe has not been affected, at least the European Union, to the extent that US or Switzerland has been affected by this crisis. Regarding first regulation, we mentioned that the Basel III, as you know, here in Europe, applies to all banks, small and big ones, large ones, whereby in US it applies only to 13 of them, leaving outside regional and other significant systemic banks. Two issues also strike. One is that in US, we had a very peculiar deposit structure. In other terms, we had concentrated uninsured depositors amounting to around 90% of the deposits in the SVB bank and in the Signature Bank. We had also the very high speed of withdrawing the bank ran, withdrawing within one day $42 billion deposits from the SVP, something we've never seen before. And also another issue is the composition of the asset sides, in other terms, loans and securities. Securities held to maturity, as we know, but when interest rates hike, when inflation goes up, then this entails risks of market-to-market losses on the long-term bonds. Some of the lessons also relate to the liquidity buffers, even of the European Union, that I don't think they're designed. It could not have been designed before, for such abrupt, speedy, digital runs on the bank, and that's an issue that needs to be thought. And also, it makes probably the difference between too big to fail and smaller ones quite blurred. And we need to rethink, I think, the whole issue of regulation in this respect. Some big questions I think we'll discuss in the forthcoming hours and days is to what extent various jurisdictions around the world need to extend the scope of their deposit insurance and need to reinforce lender of last resort mechanisms as bankers like Paul Tucker, Mervyn King, and others have proposed. Also, there are coming back some old ideas about narrow banking, something we have tried years back in the European Union that has not worked, but I'm sure they're again on the table. As regards supervision, Basel III was obviously implemented for the, in the case of Credit Suisse. Nonetheless, that's not sufficient because Credit Suisse is a failure of supervision. One note is that European supervision through the SSM, which takes care of the surveys, the systemic banks, has been very efficient in various respects. And I would say this is due also to a very excellent president with Chairman Andrea Enria, who's very efficiently supervising systemic banks, but also looking into the non-systemic ones. And also in that European Banking Authority is conducting a number of important stress tests. As regards resolution, which is another issue, Credit Suisse has shown that there are obviously always issues regarding the hierarchy of claims, because in the case of Credit Suisse, it has been written down the AT1s capital ahead of shareholders' capital, which is another order from the one that applied in the European Union. Still, this crisis raised the issue in the European Union about having a credible backstop. How things work in the European Union. When you have a resolution, which happens now in very few cases, there has not been widespread, probably like one in Europe, but intervenes the Single Resolution Board. The financing for the resolution operation is coming for the Single Resolution Funds. These funds holds money it will have money up to end of 2024 amounting to around 80 billion. And this fund is backstop supported by the ESM, which also has available funds around 68 billion to support that. This is the case of how the system works in Europe. Still, there are two issues, rather three issues to mention before going to another chapter, is that we need in Europe to adopt still a Eurosystem resolution liquidity, which a line of liquidity coming into play the day after the main liquidity has taken place. We need to advance with the risk management and treatment of the small and medium-sized banks, because the SRB has jurisdiction only for the large systemic ones. And we need absolutely to advance also with the European Deposit and Guarantee System. Still, these last few weeks, the European Commission, in a realistic proposal, has sent a packet of proposals regarding crisis management and deposit insurance, which I think it will be important to adopt in, I would say, in very, very, very soon, and that will reinforce to a great extent the European Banking Union financial structure. Some final observation in this regard, I would say that European Union still needs to advance the European capital markets, which is an important means of transforming the European economy, which is facing the digital and green transitions. The securitization mechanism tool, which we have used in Hercules and eventually elsewhere, can be very useful in promoting this capital markets union, as it has happened in the States, which used tenfold more securitization transactions than the European Union. And as you know, the US has one of the most important and deep capital markets. To this, I would add, it's important also to have a very strong supervisor. But the European Union needs also to advance to a targeted fiscal union, because currently it does not have a common fiscal capacity. And also, it's very important, the ongoing negotiations relating to the Stability Pact and to the common issuing mechanism. All these issues, they are and seem technical, and they are technical. Still, at this juncture for the European Union, they're of a great strategic importance, because depending on the successful, speedy, prompt implementation of this issue, that will determine to a great extent the cost of financing of the European economy. And that is a very important, not only financial, geopolitical issue in the time of very tense international competition, when US, as you have seen through the IRA and so on, they are ready and make available huge amounts of financing. To put it simply, for Europe, which aspires also to have an industrial policy for green financing, there cannot be an efficient response without a radical transformation of the European Union's financial system. And finally, there's of utmost importance, and we discussed before coming here, that the banking union and the capital markets unions, which we know what to do, but now it takes political determination to transcend, I would say, narrow national perceptions and overcome outdated legacy doctrines that have kept for a long time European integration hostage, if you want, to these old ideas. And I'm moving very quickly to the job I'm now relating to the Hellenic Development Bank. First of all, why Development Bank is important in this context of the discussion we have so far. I'm more convinced even now, even a few years back, that European Union financial integration and banking markets, European economy, growth development needs development banks. Development banks, which mostly, you know, more of you, they've been important in addressing market failures. In other terms, crises as the Eurozone crisis in Greece, whereby systemic banks could not finance small and medium-sized enterprises. There comes public, state, development banks were able to address this issue. But given the current challenges, especially coming from transitions, I think development banks like the bank I am also serve in creating new markets, and especially markets relating to innovation. The goals of the bank I'm serving, I would say there are three, or at least that's on my mind. First of all is broadening the circle of small and medium-sized enterprises. Why? Because in Greece, there are around 40,000 enterprises which are able to receive money from banks, whereby there's a big number of them outside this circle. Secondly, as I said, it's important through development banks to be able to finance the important transitions. And thirdly, also, I'll explain very soon what I mean with this pillar assessment that we are currently trying to obtain from the European Union. You see here that there is a very important financing gap in Greece, which the Hellenic Development Bank tries to cover. With around 3.5 billion euros back in 2020 to 22, Hellenic Development Bank managed, through also blended money and leveraging with the systemic banks, to provide loans amounting to over 80 billion. That has helped employment at least in 306,000 cases. It provided new loans around 41 million, created also new jobs. How the bank works. The bank gets in financing, you see, from the Hellenic Republic, which is state money, from the EU funding, the so-called ESPA programs. Also, it's very closely linked to the EIB, European Investment Bank, from which, for example, this week we have launched 4 programs amounting to around 400 million euros, making them, if you want, services, products for small and medium-sized enterprises, and also from other investors. We work mainly through guarantees and through co-financing, not yet fully grants. You'll see here how some of the ideas that the banks, development banks like ours, plays in a counter-cyclical policy, how they take the lead, as I say, and implement and integrate sustainable development practices, how they join forces in providing finance, how they leverage also financing. Let me give you only one example before closing. This is the so-called innovation fund that is managed by our bank. In case of innovation funds, we provide a loan with a duration 10 years, whereby you can benefit of 3 years grace period. If within, I think, the next 3 to 5 years, the borrower has managed to fulfill some criteria regarding to innovation, this borrower can take back around 20% of its loan. 20% of its loan is a bonus. You see, one of the ways that we try to foster the innovation and market. I'm going very quickly here. That's a kind of the vibrant ecosystem we have. An inaugural operation that is not giving money, but bringing together, I would say, innovators, incubators, other operators. Here is several other ideas we can discuss later about innovation. And here is, as I said before, the ecosystem we operate. My final point is this pillar assessment. Pillar assessment is a procedure whereby if one fulfills the criteria of the European Commission, obtains a certification. Why this is so important? Because the Hellenic Development Bank, we are prepared to submit the full application to get this certification. What we'll be able to do when we have this certification, most hopefully by the beginning of next year. Point one, we'll have direct access to EU funding without getting through, I would say, the various ministries and other procedures. And secondly, we'll be able to be entrusted as financial partners of the European Commission in handling EU financing in non-EU member states, which is a huge operation for us close in the region relating to the Balkans or to the Mediterranean, but also one can bring in mind, issues relating to the other continents. So this is a great bet right now we're having, and I hope that we'll be able to obtain this certification in the very near future. Mr. Chairman, I'll be stopping here because eventually there might be some questions. Thank you.
Thank you very much, Mr. Zavvos. Yes, we have like close to 15 minutes time for a discussion, so I would like to open the floor and take questions from anybody in the audience like to pose a question. Yes.
Thank you, Mr. Zavvos, for the very insightful presentation. My name is Panagiotis Barkas. I actually work for the European Securities and Markets Authority, so one of the childs of the crisis in terms of institutionalization and the post-crisis capital markets next steps. And I have a twofold questions, if I may, drawing from your presentation. The first one is you mentioned somewhere that we have a not so developed capital markets union, quoting. Plus, yesterday, also a piece of information, the European Commission launched the RIS, the Retail Investment Strategy, in terms of fostering more retail investors in order to complete these capital markets. So in the steps of further integration. My question is, what are the next steps in your view in order to move towards closer integration and the capital markets union being more developed and not so developed? And the second is, how does your bank, as chairman of the Hellenic Development Bank, ensure the crowding rather than the crowding out of more private sector, if I may, investors in a country which is exiting at the moment a decade or more than decade-long crisis, and we're moving towards more market-based financing. Thank you.
Yeah, thank you very much, Mr. Barkas, for your, I would say, most pertinent questions. It couldn't be more important question, the question you have rightly raised concerning the next step of the European Capital Markets Union. Why? Because Europe is a banking-centered finance. But we have seen during the crisis that banks can really have serious problems, as was the case of the Eurozone, which I said we faced. The most important problem of the Eurozone was the banking problem. Therefore, you need a fully functioning capital markets to be able to function as a risk-sharing, risk supporter of the European banking union. This is the case in US. This is the case of how Hercules, I would say, in its microcosm, managed to solve the problem of the Greek banking system through using the capital markets instrument. This is the case that Europe needs after especially Brexit to move speedily in developing, I would say, this market, because the biggest financial center still is outside Europe. This is the case because Europe, with the European deep liquid capital markets union, cannot be competitive on a world stage. See what's happening in the US, as I said before, which has a most thriving capital market, and what's still happening in Europe, whereby not only the banking markets fragmenting, but also the European capital markets are fragmented. And to give you an example, we know by now that Europe has got sums amounted to over 350 billion savings, remaining, I would say, somehow stagnant, whereby a very important part of the European Union desperately needs investments. We have not yet put in place the necessary mechanisms to convert this important liquidity into useful investments for the European industry, for the European households, for the European small and medium-sized enterprises. But your question relates also to a very important issue. What needs to be done? Because currently, put it mildly, the Capital Markets Union, as some say, reminds a little bit of Christmas tree. Everybody puts on it its wishes. There are a lot of initiatives, not now, not only the last 5-6 years. I've been working that for 40 years, I would say. The issue is that Europe now needs to take bold steps, especially in two main sectors. One is to reinforce with full-blown powers ESMA, the authority where you work. There's no way to have a capital markets union without having important institutional and supervisory backbone. That's the last 100 years lesson learned from the US, that has Securities and Exchange Commission established back in 1934-35. And there is no justification why this issue is not at all on the table of the European Union right now. The second issue is how you have to advance and what you have to move. Hercules sends the message that securitization is the low-hanging fruit of the European financial integration, and that needs to be used much more extensively. Needless to say, that European Union has currently a very important, probably the most advanced framework on a global level regarding securitization. That's nothing to do with what has happened, 15 years back in the US, the subprime. Therefore, this framework has to be streamlined to be able to finance the needs of the European economy. And to come back to my message, there's no way for Europe to be able to have an efficient industrial policy unless be able to create a fully blown capital markets union. Regarding your last question, I would say I get the message. We're not yet, but we have thoughts about crowding out, and I'm sure in the near future, we'll be able as a bank also, and we're working with some experts already to be able to have, if you want, a specific contribution also in this respect. That's what the second part of your question. Thank you.
Okay, just to remind you that the Hellenic Development Bank is a quite new institution, right? It's about 5 years.
You're right in terms that's, I should be said, Racing, that is a very new institution. It has also an old legacy with the other funds, but it's a very brand new institution, which somehow what we're doing, it's a great occasion to say, we're mostly in what we call retail business, providing funds for small and medium-sized enterprises, also for certain sectors, also for certain regions. But we have also a subsidiary, which is a fund of funds dealing with that. We also in close cooperation, what I didn't say before, with the very major European development banks like Banque Publique d'Investissement of France, which has helped us years back to shape what stands today as a Hellenic Development Bank, and also with the KfW in Germany. We're in very close cooperation with these two banks, but we're new, but still I would say with great ambitions to play a major role as supporting the Greek economy in this very important turning point.
Well, thank you. We have one question from Tony, one from Stefan as well, and Barbara.
Thank you very much. My name is Anthony Esteva de Ordal. I'm with eBay, and formerly I was with the Inter-American Development Bank. And I have a question regarding your work now at the Hellenic Development Bank. Two questions. One on the pillar assessments. Just was interested in knowing if the criteria that apply for complying with this assessment is the same that applies to multilateral development banks. I was involved in the negotiations of the IDB to get these pillar assessments. So I was just curious if the same criteria apply to national development banks as and the multilateral development banks. And the second, if I know that the Hellenic Bank is relatively new, are you part of the Finance in Common initiative that is steered by the French agency that try to bring together all these public development banks in Europe and around the world? I just was curious if you are part of this.
Can I go back?
Let me just take all the questions.
It had a picture with all our...
Would you like to take all the questions?
Yeah, surely. That's one. Okay. Yes, please.
Thank you very much. My name is Stefan Schulmeister from Vienna for this excellent presentation. As I learned, I have the feeling that you think that the main purpose of the banking system is to serve the real economy. And isn't it that the reason why it is so often necessary to bail out banks has to do with the long-term development that striving for profit has shifted from activities in the real economy to financial activities of all kinds. And the simplest indicator for that is the sum of the balance sheets of banks relative to GDP. Even if all investments, all export activities would be financed through the banking system, the ratio of the balance sheet to GDP would be less than 100%. But it is 200, 300, 400%. Why? Because the banks at the same time are creditors and debitors within themselves due to a tremendous amount of speculative activities. From any kind of trivial CDS transactions to, for example, the repo market. I don't want to go into technical details, but in this sense, I think that, and I would like to ask you, if we need not a systemic change, not just have measures in order to intervene in case of acute crisis, when the authorities themselves always break the rules. For example, when now the Silicon Valley Bank was saved, of course, authorities broke the rules and bailed them out. That's all. Thank you.
And one last from Barbara. I think
Barbara
that's the final one because we don't have any.
Barbara Fritz from Freie Universität Berlin. I was very impressed by the mechanism you described to load off the non-performing loans from the banks, your Hercules mechanism. And this is a very interesting mechanism. I ask myself where the limits are and if there is not involved an implicit contingent liability for the Greek state, which is additional to the formal. Because I can imagine that capital markets take up and buy these highest guaranteed, best rated vehicles, but the other ones, the mezzanine at the junior level, what if the markets don't take them up, or if they take them up at very low prices? Who covers that?
Thank you. May Right. I would say thank you honestly very much for your questions, the façon de dire. I highly appreciate because it gives me the possibility, to reply wherever I can on these issues. The point one is that the question regarding the conditions of pillar assessment and whether they are the same or not, that I cannot reply straight. But what I know, and I can tell you, is that the conditions for fulfilling obtaining the certification of pillar assessment, there are over 150 pages. What does it mean? In order to be able to fulfill these conditions, your bank has really to be in an excellent corporate governance situation. And my goal is exactly to help my bank through these exercises to be able to build, because the new bank, it's a bank that's already in a very important transformation, to be able to meet these challenges and therefore serve its clients and the Greek economy. We're going a very, I would say, painful, hard, challenging learning curve, and I hope we will be able to reply and to respond then in a very, very near future. I would say also, since from you that you are coming from international multilateral institutions, securitization in Hercules is very highly important, I think, for people to think as a means helping non-EU countries to solve their problems, obviously adjusting, to each country's or environment's situation. Our colleague from Vienna has raised a very important issue and probably goes to the hardcore, I would say, of the current thinking regarding the purpose of various actors in society, including the banks. Banks, I would put it bluntly, are not there only for their shareholders. Banks should be able to serve, I would say, national economies, households, small and medium-sized enterprises, and more importantly, I would say society, because the whole exercise of financing sustainable development, which is one of the top priorities of the European Union, requires new skills, new visions, new targeting of banks, new instruments even to be able, to move from the armchair sometimes situation into getting and helping the more, I would say, needy, the more vulnerable, and even sectors of the society, that they are not bankable. That bankability is one of the biggest issues. And SDB tries exactly to extend, to improve the bankability criteria through providing KYC instruments, through, I would say, guarantees, lowering the finance. But you have raised a big issue also regarding, I would say, the over-leveraging of banks. Obviously, there you don't need so big banks, I would say, as the ones been elsewhere, because they create somehow big risks for financial systems, and therefore it would be, I think, quite useful to be able either to provide instruments or to be able to address these issues from a supervisory point of view through more careful in banks' leverage. We have seen the developments, what has happened back in the last crisis. We have seen also what is the Credit Suisse case right now. And I fully agree, I fully subscribe to you that we need to think again the structure of the banking system in a more, I would say, appropriate context. Regarding your question about what would happen and if there, I was trying to get back to be more convincing, and I don't know if I can advance. This doesn't work here to show you.
Can we put back the presentation, please? Μπορούμε να ξαναβάλουμε λίγο την παρουσίαση.
Ναι, λοιπόν, what I want to say here is the following. When Greek state provided its guarantee for the senior tranche, a provided guarantee, which is partial to the whole structure. It's provided guarantee only for the senior tranche, which, as I said, rated, most transparent, and most secure part of the transaction. The Greek state, sorry. Okay. Let me come here for a minute. The Greek state, as I said, provides the guarantee here. For this guarantee, is paid back is paid back a fee. The Greek state does not provide a guarantee for mezzanine, does not provide a guarantee for junior. But let me tell you something more important for that. And I think I'll reply to your question. Before getting the authorization from the European Commission for Hercules, we had to go through the test, the market test. What's the market test? That before making functional the guarantee, 51% of the transactions should be sold to the markets. Therefore, before providing the state guarantee, you are sure that the market has already bought this part. Otherwise, the guarantee does not work. Otherwise, the state does not give a guarantee. And we have here a structure of guarantee that is with several seals. Within this transaction, we have, point one, a liquidity buffer. In other terms, if there are problems from the returns, because the servicers here need to make their money, need to get some returns, through all the transactions. If there are ever kind of delays, there's already within the structure, there is a liquidity buffer. The state has set also a very important mechanism supervising daily the functioning of Hercules. Let me say also that Greece coming close to what is the investment grade is great news for Hercules. Why? Point one, because this portfolio that remains within banks is already appreciated. State risk is diminished, okay? We have also other structures that if ever you need to liquidate and to be able to pay from this transaction, you start from the junior notes, not from where the state is providing the guarantee. Until now, CACs in Italy, it's a huge operation. Hercules here in Greece, they had no problem so far. But even if there were the case sometime to have a call-in of guarantee, I don't know, 5, 10 million, whatever, you have already, the state has already obtained the premium paid by the banks and be able very easily, to cover this part. Therefore, this transaction is based, as I say, on 3 tests. The market test that was provided by the DG Competition of the European Union, that's open. The test that this contingent liability does not reflect within the state's debts is not written. And thirdly, that is an issue that attracts only 0 risk, which is, I would say, an ideal operation for this thing. And all this operation is functioning within a very tides, surveyed European framework regarding securitizations. That's why I said it stands for a model that eventually can be used, by multilateral and other organizations. Okay, thank you.
Oh, thank you very much, Mr. Zavvos. I think it was a very, very interesting presentation and an interesting discussion and questions. We'll take a 10-15 minute break before we move to our next panel. Thank you.